Hello YouTube, this is Steven with On My Way to Fire. Well, it's been a few weeks since I posted a video. I took a little vacation. I'm back to work, and we're in a new week here where the war and the Iran situation is still going on. Just offer some insights from my experience and what I'm doing right now. I'm not in panic mode, but it is a little frustrating. If you trade on your own, this is a market that's very seesaw, back and forth. Any relatively good news of peace talks or agreements, proposals, the market will shoot up for a little bit and then it will give it right back. So I think based off what I've been seeing, we're pretty much in a do-nothing market. If anything, it'll probably continue to drop a little bit more downward. I think the news, the White House, the government, trying to remain mostly positive on everything that's happening right now, but I just don't see it. The oil is really what it's coming down to with the Strait of Hormuz, and it's really locking up the market as far as causing people to sell, a lot of stuff selling off. There's just no catalyst for the market to go higher. So what am I doing? Well, I have energy stocks that I purchased in the last 2 years, and my theory on that is to buy stuff when people absolutely hate them. So I purchased natural gas and oil stocks going back a few years ago, even going back to COVID, and I bought and sold a few times, but I've mainly been accumulating probably since 2022, 2023, and at this point I do have some shares that I can sell at a profit and redistribute that cash into the market for a gain and purchase something else that's at a low. So I think it's just something you have to be patient with. You can't expect some of these things to turn around the next day. And glasses here are kind of falling off to the side. But the main takeaway I got is my oil and gas stocks really compose only about maybe 5 to 7% of what I hold. So it's not a lot, but I'm glad I have it because some of it's doubled or even tripled from where I bought it at. So it's just one of those things. You got to be super, super patient, and you got to understand when the right time to sell. What I do is I look for the price to be up 2 to 4% within a day, and I'll set a high limit order saying only sell if the share hits a certain price. And I have the patience to do that, to set these limit orders for 2 to 3 shares at a time and just onesie-twosie it, keep setting them, and if it goes higher, set another group up for sale at a higher cost. And it's worked out pretty well to where I've sold off a pretty good chunk of what I had. So I maybe sold off about 20% of my oil and gas in the last couple weeks. And the stuff I do like is continuing to go down. But I know that once an agreement is made and the strait is open with the ships and the tanker ships being able to go through, it's going to have a huge rally. And something that happens is called a short squeeze, where the people that were shorting the stocks, they bet on the stocks going down. Well, they also have to do that on margin, where they borrow. So time's kind of like ticking away because it costs them money to short the stock. If the stock keeps going down, they're making more money. But like the juice is running as far as like how much interest they're going to be charged. So at a certain point, the stocks will flip and they'll start to go back up. They'll get what's called a short squeeze, and you can see some insane rallies. Going back a few years ago, I saw Target go up like 30% in a day because it had an unbelievable earnings, and there's so much short activity that people were forced to buy back the stock to close the position. So that's the way shorting works. You sell it before you buy it, but in order to do that, you have to borrow against the shares. So it's kind of a complicated thing. I've tried it once years ago with Google, and I lost like $5, so I just got out of it, and I didn't want to do it. And looking back, it was kind of stupid. I just thought, well, Google's a couple $100 a share, and there's no way it should be this high. And my logic was flawed, and I learned an inexpensive lesson under $10 to get out and not short stocks. So I'm generally a long-term investor, buy and hold. Collect those dividends, redeploy those dividends into other stuff, and then at a certain point, in a taxable brokerage account, look for a 1-year long-term capital gain, and kind of have a game plan as to what I want to sell. So where I'm at now, the tech and probably the regional banks, tech, Trying to think of what else is really, really down. Some of the pharma stocks still haven't recovered, but you've got telecommunication stocks like Verizon and AT&T. They have had an insane rally in the last year, and it's kind of surprising because they're kind of boring stocks that don't really do much normally, and they had been going down consistently for probably 3 or 4 years. And in AT&T's case in particular, they spun off the Warner Brothers Discovery shares. And since I hold some of the AT&T, I was given a lot of Warner Brothers shares, and those shares tanked. I mean, I think they issued them to me at like around 28 bucks, and it went all the way down to like, I think 11 at a certain point. And I purchased shares here and there as it was going down, and I never really sold. So I just been hanging on to these shares, and this has been essentially what I call dead money. Well, it's not doing anything for me. There's no dividend. And now that this offer has been made with AT&T, they're going to purchase out, with Warner Brothers and Paramount, they're going to purchase out the shares from all existing shareholders around $31, I think is the final price they're going to pay. So that's great. So I'm going to get a profit of probably $3.50 to $4 on a bulk of my shares that were issued based off having AT&T. And then I'm going to get even more. I might even get double the price because I got some shares under $20. So, you know, it's been a long, long wait. And I kind of have an idea of what I want to do in terms of redeploying that cash. I think I mentioned on a prior video that I use a HELOC to fund my month-to-month purchases. And I use that as like my checking account. If I'm short on cash, I'll transfer money from the HELOC back to my checking account, cover my bills, and then as I get more dividends, I'll start to pay down the HELOC. Now doing that, my interest rate's somewhere around 6%, might be 5.5%. because there's been a few interest rate reductions. So I can manage that, managed to pay down a few $1,000s in the last few months, and my payment went down about $20. So it does make an effect as far as the future payments, but if the Fed decides to raise interest rates, then it kind of screws me over to where my payment goes up. And on the other side, if they cut the rates, then my payment goes down even more because the interest rate per month is reduced. So I'm keeping all this in mind. I'm trying to be a little bit more mindful and not go all in on the market. We've got so much volatility. I think time is my asset. I don't think this war ends anytime soon. So the way I want to play it is let my monthly cash flow do what it needs to do. Whatever little margin of extra cash through dividends and paychecks that come in, I'm going to put that back into the market for the long term. And I still want to fund my Roth, but I think the overall goal right now is look for long-term holdings in my taxable brokerage account that I can buy now at really fire sale prices. These stocks have gone down quite a bit. You just got to be very, very patient. And there's times where I set a limit order and the purchase doesn't go through. So it's just going to happen on certain days. So I pretty much have dividends coming in throughout the month, and there'll be dry periods of like 2 to 3 days where I don't have any money coming in, and I have to either sell something or just not buy. And so those days are hard. You got to figure out what to do. But I have the patience to have those days where I don't do anything, and I'm okay with that. It's not something that I have to buy every day, but I'm looking for the better prices and the best move that I can make really for the week. So there's going to be times like that where I don't need to buy, and I'm okay with that now. In the past, I kind of had a little bit of that FOMO feeling, as some people say, fear of missing out. But I think as a long-term investor, you want things to kind of play out for a while, see how it does, and not jump to a conclusion to just dump all your money in at once, because a lot of times what will end up happening is the stocks will go down even more. And you're like thinking, oh, this is a great price. Well, the stocks continue to go down. It's even better price. So you do want to participate, but you also don't want to overdo it while you're getting in on a dip. You're basically catching a falling knife, as they call it. When you zoom out, though, and you go maybe 6 months to a year later, you look at all those purchases and you'll laugh at being so concerned about getting the best price every day, because mainly you're just trying to get in while this dip is occurring. And you have some software and tech stocks that are down well over 20%, maybe even 30%. I really think you got to look at those and see which ones are profitable and which ones don't have a lot of scandals. If you look at Meta, which is Facebook, they just had a big case where it went against them for social media addiction. And I think Google with YouTube was the other company that got affected by it, and they got sued. And it's caused those stocks to go down. So I haven't really been following Google, but I did hear Meta was down quite a bit. Microsoft's another one, not related to the social media lawsuit thing, but just really getting hammered. And I think that all comes back to the AI stuff. There's been a lot of narrative about AI companies taking away the pricing power. It's probably what they're getting at of some of these companies that have contracts. So like Salesforce, Microsoft, all these companies were going down quite a bit for the last couple months prior to the war starting with Iran. So it's a real interesting time right now. The other thing I'm considering is the filing taxes for the year. It always sucks to file taxes. And since I'm an investor and I live in California, they tax you on the dividend income with no special reductions. And what I mean by that is on the federal side, they have something called a qualified dividend. So if you own a major company like Walmart, Pfizer, AT&T, Verizon, Coca-Cola, they have qualified dividends. And you get one step below your tax basis. So basically a lower bracket. And if you do your deductions right, you can set it up to where you have enough margin between your brackets that the next bracket below where you're at is 0 and you don't pay any federal taxes on it, which is great because that allows your money to compound more and more. And you can keep that money in your taxable brokerage. So that's what that's all about. So that money is accessible. I don't have to wait for retirement age to get it, but I have to pay taxes on it every year based off capital gains. So if I sell anything from that account, it does a match up with the TurboTax, and it says how many shares did you sell, how long did you have it, did it qualify as a short-term or long-term capital gain. And I really focus on long-term capital gains along with qualified dividends. There's times where I sell on a short term, but on something like that, it could be something to where I'm not confident in the stock and I'm basically just breaking even. So there's no money to be made. So I'm fine with that. I get a profit of like $3 on a couple $1,000s. I just want that cash back. I really don't care what the value is at that point, that I made any money on it or not. I need that cash back. So at the beginning of the year, I was looking at my portfolio. I was thinking, okay, I think I sized out a few opportunities. If we get a rally, I want to sell. And so one of them was a pharmaceutical that was a spinoff of a major pharma company that you all heard of. And I had a lot of shares because I thought, this is a pretty safe, stable play. Well, similar to the WBD, it was spun off from a major company and it promptly tanked. And that stock went down and down and down, went up, went down, went up, went down, down, down. And so long and short of it was I bought and sold shares in the past, basically got what I called the stinky shares, the shares that were at the highest cost basis. I was able to sell them all for more than I paid for it and basically just break even on those shares, get out of them. And then when the stock dips, I would buy it back. And I sold off a major chunk of that though. I sold off probably around 35% of what I held. I didn't quite sell all of it. And I don't know if that was a good idea or a bad idea. On that particular one, it has since gone down about 25 to 30% from where I sold it at. So it's tempting right now to buy it back again to get a new round of shares set up for a long-term capital gain. But I'm going to be patient. If anything, I might just buy a handful of shares, maybe 1 to 5 per month, really slow. And then I get another dividend on that one in about 2.5 months because it just paid. So that's going to be a really long-term play again. Wait for that share price to go back up. I really don't know. They had some controversies with different things that caused the stock to go down. And you would think it's a boring stock, but stuff still happens in that sector. For the most part, hasn't really come back the way it should have. But I kind of just lost patience with it. So when I saw a rally, it was on my radar, and I'm glad I did sell because I was able to fund my Roth account. And I'm well ahead of where I was last year. So I'm about 50% of the way. The limit, I think, is $7,500 for the year. So I guess I'm about 40-some% into that. I think I'm just about $3,000 for the year into the Roth with 2025 fully funded. So that's a big change from last year. I was barely getting to topping off 2024 by March of last year. I didn't quite have the cash flow going to fund the Roth until the deadline, which is right around tax season. So this year I'm doing a lot better. I think that also comes down to just like not comparing yourself to other people. I compare myself to what I did last year and the year before and the year before that. And I'm kind of in my own little world as far as where I'm at. Looking back at a statement from a year ago, I'm at like a 30% gain in terms of value. Even though the market's down, I think I'm down about 8% in my Roth account right now for the year. Despite putting money in, I'm pretty much back to the same balance I was at the end of last year. So it is a little bit frustrating, but it's one of those things. Month after month, my dividends are just rolling in. I'm accumulating more shares, and as soon as stuff turns positive, I have a whole list of stuff I can sell. And there's no tax implication on that because it's in the Roth account. That's the benefit of trading on the short term. So I'm willing to take a few more chances in that account. It's actually worked out really, really well. So I'm excited to see what holds as we get into June and September, because I think by then a lot of this stuff have already played out. And I'll just be glad that I put money into the market while I did what I could. I didn't overdo it. I didn't overextend myself. I've reduced my house payment probably by about $50 to $75 in the last year. And so that gives me a little extra cash to put into the Roth and to pay off and maybe even reward myself with a little treat here and there. So I think that's really just the takeaway from this video. I don't want to compare myself to other people, what they're doing. Maybe just take it in for maybe just little tweaks, but I know what works for me. And I'm looking forward to seeing what this year does in terms of building up more shares. Now, as far as my workplace 401k, that one, I've put in quite a bit for the year. I was maxing at like 35% of my salary into the 401k. And I've been buying this dip the whole way down. And on a prior video, I was mentioning how I keep somewhere around 10 to 12% in stable value and short-term bonds in my 401k. And the idea there is to use it as dry powder for a sell-off. And so this has kind of been a slow bleed as far as what's this market going down right now. It hasn't been like a crash. It's just been like a slow downward decline. And it's just a little bit more week after week. So I've been very, very patient. And I bought some company stock that's down over probably about 35% from the high. So I'm happy about that. I got in on that. Made one big purchase on that. And I looked at small and mid cap last week, and I put some money in on Friday from the stable value fund. So I probably spent about 20% of my reserves of my cash that I have on hand. And that money was just basically earning between 2 and 3% annually. But it's just sitting there waiting for a crash or a sell-off for me to put some money to work. So I figured 20% is probably a good number just for now. I want to let this play out a little bit more. If it just kind of goes sideways, I'd consider putting in about maybe 5% more. I've reduced my contribution weekly, or I should say per paycheck, to only about 3% cash. I'm just basically letting the pay periods rebalance, and I changed some percentages to go a little higher in the company stock and the small cap and mid cap. So between that and these transfers, I'm putting a sizable amount back into these. And I think it was around October, November, I sold somewhere between 6 and 8% of what I had in small cap, mid cap, and international. And I put that back to cash. So that stuff's been sitting there for 6 months. Plus I was at probably about 10% cash each paycheck, just a few dollars every check going into those cash funds. So that's where I'm getting that 20% that I just put into the market, getting it from there. So it's kind of a lot of things I'm juggling in my mind, how I want to do it, but I don't want to overdo it, not overthink it. It's a long-term game. You're not going to time it on the absolute low most of the time, but you got to take advantage of these dips when the market's selling off. And in this case, it's kind of a rational sell-off, though it's not an irrational. We've got issues with supply chains, with the oil. Everybody's panicking as far as what's going to happen in Asia, in Europe, as far as what's going to happen, and they might even have shortages. So one of the guys I like to follow is Mohammed El-Arian. He's a guy from Queens, Cambridge College, and he talks about bonds, and he's just a smart dude, and he's on a lot of shows. A lot of people get mad at him because it seems like he's making excuses for the administration, but I always think he's pretty level-headed and nonpartisan when he's talking about different scenarios. So I watched a video with him today from CNBC where he's just talking about supply shock and shortages and how it's going to affect the market and what's going to happen. So I think we're probably prolonged overall in the situation. There's really no end date in sight, and it's just kind of a slow drift down. So this is quite different from 2020 when everything sold off due to the illness and everything we know about what happened then. And it took about maybe 4 or 5 months before everything really started to come back. And it was a weird time because stuff just sold off instantly, and it was more of a crash, in my opinion. At that time, it was a sharper sell-off. Then this one is just kind of drifting. Small rallies on the news from the White House trying to say that there's Pakistan is helping and all this stuff. At this point, I just use that as an occasion to sell. If I see something I want to get rid of at a break-even cost or at a decent price, and we have some kind of small rally, I'll go ahead and sell when I hear about these positive news things, because most often we're seeing these things just fizzle right out. So just want to thank you guys for stopping by on the channel here. Get back to doing videos on a more regular basis and just talking about the market. But I wanted to update really with the war, what's happening, how the market's reacting, how I see it, and how it's just kind of the nature of the beast. When you invest, there's market fluctuation. Sometimes you're riding a rising tide, as they say, and everything's going up at the same time and you feel like a genius. And there's other times that you buy stuff and it just keeps going down. So instead of buying 100 shares of something for a few $1,000s, I'm putting in $50 to $100 at a time here and there, and just keep putting in limit orders on specific shares that I want. And whether it's buying or selling, just being extremely patient. I'm dedicating a lot of time to it. And I think in the end, it's going to work out. I'm getting multi-year highs on some of these oil and gas plays, and they pretty much could evaporate overnight if some kind of situation happens where there's a peace agreement made. We're going to see an epic rally, and I really don't want to miss out on that. But at the same time, I have to be smart about trimming back when I get to multi-year highs. I got to get some of those high-cost shares out of there and rebalance the portfolio. So I think for next year, my goal is going to be to reduce a lot of my dividends, because the taxes are just out of control once you start really building a sizable account. So I have a workplace employee stock plan, and I hardly ever sell shares out of that. So that's accumulating, as well as a couple other trading accounts. And we're starting to get into quite a bit of stock that I have. Now, a lot of it's negative right now, but you just got to ride these times out and get ready to rebalance. So any opportunity that I have on stuff that I'm not confident about, that's break even, I want to get rid of it. I want to reduce the debt on my home equity loan and get that payment down. And that's a guarantee. And I think that's a good motivator, because it's kind of like a reverse savings if you think about it. If you put money into a checking account or a savings account, you're going to get back a few percent of interest per month, but it's not really all that much. So with mine being about 5.5%, that gives me incentive to get that balance paid down, because every dollar that I pay cuts that interest for the next payment down by that 5.5%. And so I'm saving money by paying down that loan, but I'm not really earning it per se. I'm saving on the payment. So as they say, a penny saved is a penny earned. And that's how I use it as motivation. 5.5% interest rate. You're not going to get that on any CD right now. I think the rates are probably around 4% or maybe 3.5% on a savings account, or even on a CD. So I'm willing to float it out, wait it out here with the market, see what happens, get some of these stocks back up towards the end of this year. And if I don't, I don't. But at least I've reduced my monthly payment by that $75 per month, and it keeps going down $5 or $6 a month as I make payments. And I've, kind of like a short-term goal of what I have right now is just pay down $200 extra as just an ongoing thing. And then if I do have to draw on that due to, an increased expense, probably the home insurance is the big one. It's going to be due in August, and it's also timed with the second payment for my auto insurance. So that's a killer, because it's like $900, and the rates just keep going up on these things. So planning out for the future, not getting caught up in the day-to-day news. I'm in a much better position than I was 5 years ago or even a year ago. So it's really just about perspective and not getting frustrated with the market. Let things settle out. Let time be my asset and just keep doing what I'm doing because it's working. It's just you just need to know how to ride out the cycles. And I think that's the unknown. That's the thing that makes people uneasy, is not knowing when is this going to end? When is the market going to kind of correct back to being in a positive territory? We had such a great end of the year last year, and now we've given it all back. And we're probably back to where we were in August or September. And I wouldn't doubt it if we continue to go down probably another 3 to 5% from here. And that would be somewhere around a 10 to 15% correction, depending on what sector you're looking at. So, you know, it just is what it is. These are the times where you still put money to work, not get frustrated, and just keep on keeping on. So thanks again for stopping by, and I'll post a new video soon. Thanks, guys. See you later.